Hello viewers, in this session I will introduce you all to the concept of investments and securities, and I will also explain the definition and meaning of investments and securities, and I will further explain the evolution, development and modus of investments and securities in India. And finally, I will explain briefly the various laws on investments and securities in India. Investment means employing money for some profitable use. It could be in any form like purchase of immobile property, deposit of money for interest, commercial lending of money for interest, purchase of shares and debentures, etc. If the money is invested in shares and debentures, it is called investment in securities. The securities have the nature of easy convertibility into cash, called liquidity, and they may grow in value and are saleable. Even though the immobile properties are saleable, the concept is totally different and the application of law is also entirely different. The securities are easily saleable and have less cumbersome procedure in comparison with the sale of immobile properties. Employment of money for a gain in any mode, including in securities, is called collectively investment. This investment, that is, employment of money, is the basic subject matter of financial market, which deals with the capital market as well as the money market. Capital market consists of securities market and various other forms of lending and borrowing. Money means liquid cash either in hand or in the bank. Money is the medium of exchange for all transactions, including the exchange of goods and services in human life. When a person fulfills his basic needs, he will look forward to invest his money for a better life and also his social security, and in that direction he will employ his money in various options of investments which include securities. When a person invests his hard-earned money, he expects proper return as well as security for his investment. In this direction, the viewers must study the laws governing investments and securities in India, in particular and in the world in general. A separate mechanism is provided on regulation and control of investments and securities in India. In every country, the investments and securities basically depend upon its financial system and the economy. The economy and its growth depend upon the sound financial policies of the government of that country. A sound financial system is the life spring of the modern economy of the country, which plays a very pivotal role in the economic growth, capital growth, production and distribution of goods, and of course, providing services as well. The financial system of a country comprises of financial assets, financial services, financial market, and other contributing factors like banks, non-banking financial institutions, both government and non-government, etc. The calibration of an economy is carried through economic indicators like growth in gross domestic product, called GDP, the production of goods and services, agricultural production, the quantum of rainfall, inflation, deflation, the status of balance of payments, the foreign exchange reserves and investments, etc. Thus, the investment in securities depend on good functions of a good financial system. Good functions of financial system includes availability of liquidity, currency regulations, banking functions, cash reserves, control of credit, fiscal policy of the government, and other related contributory factors. In India, the economy's financial system is based on financial market, investment products, market participants like derivatives, etc. The financial market, which is very relevant to the present subject matter, has two major segments called money market and capital market. The money market pertains to exchange of short-term funds to solve the liquidity requirements of the borrowers. Normally, Money market consists of such financial claims whose maturity is under a year, having low default risk, high marketability, high accessibility, flexibility, and other related contributing factors. The capital market is called a market for financial investment, which is direct or indirect claims to capital. It consists of securities market, both primary and secondary, and also various other forms of lending and borrowing. As it includes the securities market, its scope is very wider than securities market. It covers all the forms of lending and borrowing. It also covers various aspects of term funding, long-term funding, which is basically through institutional help, and it makes available the funding to business community, individuals, and also even to the governments. The capital market also contains the process of transfer of securities. It covers both loan capital and the share capital of corporate, non-corporate business houses, individual investors, and also the governments. The capital market also covers the stock exchanges, that is the marketplace for trading securities. Several laws have been incorporated by the governments in India to regulate both the money market and also the capital market. Definition of investment. Investment can be viewed as a generic term to mean employment of money to get a return. According to the Oxford Advanced Learner's Dictionary, investment is to buy property, shares in a company, etc., in the hope of making a profit. According to the Concise Law Dictionary of Sri P. Ramnath Iyer, investment means to employ for some profitable use, convert into some other form of wealth, usually of a more or less permanent nature, in connection with money or capital, to give money for some other property, to employ money in the purchase of anything from which interest or profit is expected. Thus, investment denotes the employment of money for a gain. Investment denote the different options of employing money in different alternatives, which include the securities also. In India, the subject of investment is covered under different laws like the Securities Contract Regulation Act 1956, the Reserve Bank of India Act 1934, and the various RBI regulations, the Prevention of Money Laundering Act 2002, and other related legislations. Now, the definition of securities. The word security has a special meaning under different economic and corporate legislations, as against the general meaning of safety, assurance, guarantee for the payment of a debt or the performance of an act or a promise. As per the Concise Law Dictionary of Sri P. Ramnath Iyer, securities means any of the following instruments issued or to be issued or created or to be created by or for the benefit of a company, namely shares, stocks and bonds, debentures, mortgage deeds, instruments of pawn, pledge or hypothecation, and other instruments creating or evidencing a charge or lien on the assets of the company, and instruments acknowledging loan to or indebtedness of the company and guaranteed by a third party or entered into jointly with third party. This definition, in fact, was quoted from the repealed Capital Issues Control Act 1947. As per Article 366(26) of the Constitution of India, securities include stock. As per Section 2(1) of the Forward Contract Regulation Act 1952, security means any of the following instruments issued or to be issued or created or to be created by or for the benefit of a company, namely shares, scrips, stocks, bonds, debentures, debenture stocks, or other marketable securities of a like nature in or of any incorporated company or other body corporate, and also government securities. According to Section 2H of the Securities Contracts Regulation Act 1956, shares, scrips, stocks, bonds, debentures, debenture stocks, or other marketable securities of a like nature in or of any incorporated company or other body corporate. Derivatives, units, or any other instruments issued by any collective investment scheme to the investors in such schemes. Government securities, such other instruments as may be declared by the central government to be securities and the rights or interest in securities. As per Clause ZA to Section 2 of the Foreign Exchange Management Act 1999, security means shares, stocks, bonds, and debentures, government securities as defined in the Public Debt Act 1944, saving certificate to which the Savings Certificates Act 1957 applies, deposit receipts in respect of deposits of securities, and units of the Unit Trust of India established under subsection 1 of Section 3 of the Unit Trust of India Act 1963, or of any mutual fund, and includes certificates of title to securities, but does not include bills of exchange or promissory notes or any other instruments which may be notified by the Reserve Bank as security for the purposes of this Act. Thus, the word securities in the context of investment denotes the employment of money in shares and debentures, bonds of companies, and also the government-sponsored investment schemes. An investment in non-securities like fixed deposits in banks, recurring deposits, etc., are not covered by the legislations like Securities Contracts Regulation Act 1956 and other related legislations like the Securities and Exchange Board of India Act 1992, Depositories Act 1996, etc. The investment in non-securities is covered by the RBI regulations and other banking and non-banking laws and regulations. For investments, several options are available like various kinds of deposits in banks, non-banking financial institutions, companies, firms, and also investment in securities. The securities must be offered to public by companies only. And of course, the government also can offer securities to the public in different forms. Much emphasis is given on the regulation of securities in India to protect the interest of investors. Regulations are issued to streamline the working of intermediaries like stockbrokers in the securities market by the government. So, it is also necessary to understand the concept of shares and debentures, which are integral part of securities. For this purpose, one should understand the concept of a corporate entity, as it is the root based on which the entire stock market depends upon. The subject of investment relates to the financial market, which comprises of money market and capital market. The capital market again comprises of securities market and various other different forms of lending and borrowing. History of the financial market in India. The financial market in India basically was engaged with the taking over of Indian economy by the East India Company during the 18th century. In the ancient India, the concept of business investment was different. In fact, under the various scriptures of various religions, which are integral part of Indian culture and civilization, charging interest on loans was a sin. The concept of securities emerged and crystallized in the present form in India with the advent of the Joint Stock Companies Act 1850. It was replaced by the Joint Stock Companies Act 1857 and followed by the Joint Stock Companies Act 1860. This act was recasted in 1882 and 1913. After independence, the Companies Act 1956 was enacted, which was further replaced by the Companies Act 2013. The various corporate securities are defined and dealt with by the Companies Act 2013. The backbone of financial market in the world is the capital market, and the companies play a very pivotal role in the development and the growth of a country's economy. In India, in the 18th century, the East India Company started trading its securities and made a beginning of the capital market in India. The securities trading was unorganized till the end of 19th century. The main trading centers were Bombay and Calcutta, and Bombay happened to be the chief trading center. The bank shares were the major trading stock. There was a boom in the Indian capital market during the middle of the 19th century as Bombay happened to be a great supplier for cotton and share prices were high due to high trading activities. It is interesting to note that trading was carried at that time under a banyan tree in front of the town hall in Bombay with about a dozen, that is 12 in number, stockbrokers. First, there was an informal stockbrokers association in the year 1897 called Native Shares and Stockbrokers Association, Bombay. Subsequently, other stock exchanges in other cities were developed. Under the Bombay Securities Control Act 1925, the Bombay Stock Exchange was recognized in May 1927. It is pertinent to note that during the British rule, the capital market in India was not very well organized and developed for the reason that the British government was not interested in the economic growth of India. Due to this reason, many foreign companies in India slided to the London capital market for funding. In post-independence era, the government during the first and second 5-year plans concentrated very much on the development of agricultural sector. So, much attention was not paid by the governments on the growth and development of stock markets in India during this particular period. History shows that the stock market was revived during 1970s as Badla trading was resumed under the disguised forms of hand delivery contracts. The Foreign Exchange Regulation Act 1973 enabled many investors in India to invest in the multinational companies, and subsequently the enactments like the Securities and Exchange Board of India Act 1992, Depositories Act 1996, along with the Securities Contracts Regulation Act 1956 are regulating the capital market in India today. The Foreign Exchange Regulation Act 1973, that is FERA, was replaced with the Foreign Exchange Management Act 1999, FEMA, for better conservation and management of foreign exchange, which has got an impact on the regulation of stock markets in India. Today in India, the money market provides short-term funds to solve the liquidity needs of borrowers. The money market is an integral part of financial market. The other part of the financial market, that is the capital market, provides a market for financial investment which is direct and indirect. The capital market further comprises of the securities market and other forms of lending. The securities market consists of primary market and secondary markets. The securities markets comprising both primary and secondary market refers to the markets for securities like shares, debentures, bonds, etc., both from companies and also the government. The primary market pertains to the sale of new securities through fresh issue of the securities. The secondary market deals with securities previously issued. If they are listed, they are traded in the stock exchanges, or they may be traded in private outside the stock exchanges. The securities market would enable even small investors to have wise and wider investment options. It also facilitates the internationalization of an economy by bringing a link with the other part of the world. This is the concept of globalization. The securities markets closely deals with the issues pertaining to equity and debt, dematerialized accounts, resource mobilization by mutual funds, preferential allotment, corporate bonds, foreign investment, and other related issues. Today in India, the Indian capital market runs through two prime institutions, namely the National Stock Exchange of India Limited and the Bombay Stock Exchange Limited. The National Stock Exchange is rated as the third largest exchange in the world in terms of the number of equity transactions, the first stock exchange being the New York Stock Exchange and the second one being the NASDAQ Stock Exchange, that is at New York, managed by the NASDAQ OMX Group USA. India is second only to the United States in terms of the number of listed companies, market participants, the number of listed securities, the volume of transactions, and other related components thereon. The Indian law on the capital market was strengthened by the reports of various committees like the Bombay Stock Exchange Committee 1924-1937, the minutes of board meeting of stock exchanges of Calcutta, Bombay, and Madras, the Lok Sabha debates on securities contracts, regulation bills 1954, 1955, and 1956. Various laws on investments and securities in India. Several laws have been enacted to regulate capital market in India and also to protect the investor's interest. The prominent legislations are narrated here. A. The Companies Act 2013. The concept of shares and debentures emanate from the company legislation. The first legislation in India was the Joint Stock Companies Act 1850, which was replaced after independence by the Companies Act 1956. This act was further replaced by the Companies Act 2013. Under this act, the regulatory framework on corporate governance was strengthened. The basis of the securities generate from this legislation. This act deals with the issue, allotment, transfer, and transmission of securities, apart from dealing with the other aspects of corporate governance. It also deals with the public issues of capital, regulation of underwriting, issues on premium and discounts, rights and bonus issues, dividends, furnishing of various reports, and information to the register of companies and the shareholders. B. The Securities and Exchange Board of India Act 1992. This act aims at providing a board called SEBI, that is the Securities and Exchange Board of India, for protecting the interest of investors in securities, promoting the development of the securities market, regulating the securities market, controlling the intermediaries. Under the Act, several rules and regulations were framed. The SEBI has been given full independence and authority to ensure an orderly securities market. C. The Securities Contracts Regulation Act 1956. This enactment provides for a process of recognition to stock exchanges and their continued supervision, contract in securities, listing of securities on stock exchanges. In pursuance of the Act, appropriate rules are framed by the government. D. The Depositories Act 1996. This Act provides for the establishment of depositories in securities with the objective of ensuring free transferability of securities. It also provides for transferability of securities with speed, accuracy, and security. It also provides dematerialization and rematerialization of the securities. This Act further envisages the transfer of ownership of securities electronically by book entry without making the securities move from person to person. E. The Foreign Exchange Management Act 1999. This Act aims at conservation and management of foreign exchange. It has got high relevance to the operation of securities. This Act also defines the term security. F. The Prevention of Money Laundering Act 2002. This enactment aims at prevention of money laundering and provide for confiscation of property derived from or involved in money laundering and for matters connected therewith or incidental thereto. This Act also applies to the intermediaries like the stockbrokers, etc. Viewers, we will study further various details about the financial market and its components along with the legislations relevant thereon in depth in the subsequent lessons. Thank you.